The head and shoulders base. The head and shoulders base will be established when looking at a downtrend. We are trailing the market with a short-term trend line. It can also be a medium or long-term trend line. Price is making lower lows and lower highs, and price moves through the last short-term trend line, comes back to the last level of resistance, at which point we start to look for a retracement or a retest of the lows, or retracement to one of our technical levels, one being the left shoulder, two being the possibility of it hitting the backside of the trend line, any manner of support and resistance that may have been established on this up leg, Fibonacci retracement level, or a pivot level, with the anticipation that price will move through the neckline and beyond, and there's the possibility that price can come back and test the neckline before moving up. Here's an example of a head and shoulders bottom on a 60-minute chart, and what I really like about this is a 60-minute chart, and if we had compressed it to a 2-hour chart or a 4-hour chart, we'd still be able to see this quite clearly. But the 60-minute chart lays this out very, very nicely. Let's just walk through price action on this chart. It's a British pound, and we also have included the MACD on this chart. We see price has formed a tweezer top high here. It falls, retraces to the last level of support. It retraces again for one complete downswing. We fall through the level of support, comes down, forms a new level of support. This is a swing in one day, falls down here, consolidates. The next day it rallies. It rallies to the last level of support. This is a trade in and of itself. And look at the doji that forms, the long-legged doji that forms. And then it falls. We have an intraday downswing to a new low, and the new low is established at 18100, the figure. On this day, we see a triple bottom form, and finally on the third attempt, we see price attempt to move below and fail to move below the previous two lows established on the day. In the meantime, we have a MACD divergence. Price, after failing to make a new low, which is also a trade on its own, it rallies, and it rallies up to and through the trend line, forms another nice long-legged doji at the trend line, continues up, and meets resistance at the previous resistance and support level. Now price retraces. This is a trade also on its own. Then price retraces and softens up, leading into the next day. At this level of resistance, price consolidates, and it's a 40 pip range that we're trading in here. As London opens up, it moves price. The dealers take price down to this level of resistance, which is also the central pivot. M2 for the day, and a retracement level. It's the backside of a trend line, and in my opinion, the backside of the trend line and this level of resistance overrides any other supporting factor. We see a response from this low, and price moves 80 pips before coming all the way back and making you wobbly-kneed and fearful, and then it again rallies but does not make new highs yet until the previous day, when we see another downswing. Price comes up, rests at resistance, and then finally moves through. Well, how do we trade this scenario? Well, you know how to trade. We're teaching you how to trade, and we've got live scenarios and simulated scenarios. You want to trade straight into this level of support. You want to trade this bold-faced bearish candle straight into the level of support. Down here, you want to trade long when price fails to move below this level. Here, you want to trade after this doji when price is testing this level. This is the Canadian dollar as exemplified by this choppy and somewhat erratic price swings. Price comes down, comes back to the last level of resistance, retraces, right shoulder equals the left shoulder, and rallies. On this daily chart, this is a really nice head and shoulders on a daily chart. A nice downswing. Price forms a low and retraces. Comes back up to the last level of resistance. At this point, we now start to look for our right shoulder to form, and we will pull our Fibonacci's. We'll look at all of our key levels. Left shoulder, right shoulder. Actually, I would look closely. This is a bit of an errant swing, and I would look closely at where the primary interest point at the base of the consolidation here is where I'd be looking. And here it slips through slightly before rallying. Take some profit. This is a very good position trade. Very, very good position trade entry. It's because we're on a daily chart here. As well, we see a divergence. Take some profit before the level of resistance. But an important note here is that when when you see a head and shoulders like this develop, any intraday trades that you make for the next few days should be in the direction of the new trend, post-reversal new trend. With the exception of this possible sensitive area here. Very sensitive area, as we see by the price swing here. We rally from this base, from the right shoulder base, we rally 1200 pips before generating a new reversal formation. And down. Here's an Australian dollar 60-minute chart. I'm going to give you a quick preview here of the use of Fibonacci tool in a reversal formation. This is a short-term reversal, obviously, as we're on a 60-minute chart, but we see these nice price swings as we technically very nice support, resistance, and price comes down and forms. You see this level of resistance here, which is quite key. We see the spike low here. We can take kind of any one of these levels along here as our low, as our target point for the right shoulder, kind of anywhere along here. I like this one. Now in this case, what price does is it actually comes all the way and fills the number at 62% retracement before moving up and extending to 162%. Once price has broken through the trend line and established and reached the last level of resistance, then you start to stock your trade and you start to look for the retracement level. And as price comes down here, you can trade it at the 32% retracement with a stop below the 62 or the 79, but I usually like to wait for it to come back to 62 unless I think it's a real aggressive key reversal day that it's coming off of, and the second leg might be very strong. A British pound daily chart. These the daily charts lend to good position trades. We break the trend line. We come back to the last level of resistance. The right shoulder is equivalent to the left shoulder. But look at this. We have a head and shoulders formation inside of the right shoulder of a head and shoulders. Once you see this come to fruition, you should be trading long on your intraday trades anyway, if you're not in a position trade. But once you see the right shoulder of a head and shoulders in the right shoulders of a head and shoulders, then definitely be long. Look at the up days versus the down days, the ratio of up days versus down days. So if you're trading long in these up days after a powerful head and shoulders formation, probability is well in your favor. Here we simply have the right shoulder retracing to the 10-day moving average. This level here is also the 38% retracement and a central pivot from this key reversal day. You see the big move up, key reversal day, and then we get the retracement on the key reversal day is usually 38%, which converges with the central pivot. Just walking through this scenario once again. We have the trend line is broken, price comes back to the last level of resistance. We have a MACD divergence. Here's our newly established neckline. Now, price retraces, and this is where you make your trade as prices aggressively move down towards the equivalent point of the left shoulder and the backside of the trend line. But it is also the open of the London session, which typically will pull price down to generate liquidity so that they can push price up. And they'll make on these deals, when they're dealing down here, they make a generous amount as they start to drive price back up just from the liquidity that they've created. Again, you want to take profit on your first spike, at least 20 to 30 pips. As this is a British pound, you want to take profit at approximately 30 pips because price can come all the way back and even continue to reverse. And here's what your formation looks like after the fact, but a multitude of trades in this scenario. Canadian dollar, head and shoulders formation. This just talks about the right shoulder power that I referred to, and the right shoulder power is simply when you see a head and shoulders formation come to fruition and you see the red shoulder starting to move in and starting to generate the new trend, then trade with that momentum on any subsequent trade for several days until you start to meet a significant resistance or an exhaustion level of like an extension level from your Fibonacci extensions. Here, for example, we see a Euro 60-minute chart, a real nice head and shoulders, and the left shoulder is equivalent to the right shoulder, same price point. It's amazing how it does this. But we see a miniature head and shoulders. We see a miniature head and shoulders within the right shoulder, and there's actually a head and shoulders inside the head and shoulders. And there's just so many opportunities to trade here when we see this. We've got an opportunity down here, or here, or here, before price begins to move. And on this day, we actually see a 160 pip move on the day as the reversal formation takes effect. trade in the direction of the force of the newly established trend.